Hey everybody, Tom Berry with Investor Loan Source here, and I've got a little video I want to share with you about market cycles. You know, there's always a lot of talk in our industry about market cycles, and whether we're in a buyer's market or a seller's market, are we in the middle of a bubble, is it about to burst? Are we at the top or are we at the bottom? We hear all of this terminology and there's just a lot of noise. So I wanted to try to cut through the noise and give you a few very simple things that you can use to determine what you ought to be doing in the market at this particular time. I have always had a mindset of I want to do what the market gives me. Now, what do I mean by that? It means I don't want to try to do something that is out of favor with the market. So, for example, in 2008, Melissa and I thought we owned a flipping company. We had just got started, we had some houses under contract. In fact, I remember we had one that was under construction on Bullfinch in Houston, Texas. While we were doing that rehab, I would, always, at least once a week, go in and comp and pull up comparables to see what the property was worth. And it seemed like every month the value of that property was dropping while we were doing the rehab. It literally became a race for us to get it done, get it marketed, get it sold, and get it off of our plate before we would end up owing money to sell it. Now, obviously, we were doing this whole market cycle thing incorrectly, right? We were trying to flip a house in the middle of a market free fall. That's never a good time to be flipping a house. Now, there are things that we could have been doing, and we quickly, after we got out from under, by the way, the rest of that story is, we did get the house done, it turned out beautiful, we got it on the market, and we got it sold, and we made about $10,000 for all that effort. Now, when we bought the house, we were set to make 40 grand in profit. But by the time we got done, values on real estate had dropped so much. We got 10,000 and we were happy to get it and happy to get rid of it because we were afraid it could even fall further, and did after that. So how do you avoid getting into that situation that we got into on Bullfinch Street? Well, we've got to understand that we need to dissect the market a few ways when we're talking about market cycles. The first way that I want to dissect a market is by market. In other words, by statistical market area. For us, where I am, that's Houston. Now, that doesn't mean Houston, the city limits. That means Houston and the surrounding area, or the Metroplex, as it might be called. The Houston Metroplex is not going to have an exact same cycle up and down as, say, the Memphis market will. They will be totally different. There might be some correlation to it if you put them in an overlay, but most generally, cities are going to operate different of each other in market cycles. So while there may not be any great deals in a particular asset class in the Houston metro, it might be a phenomenal time to invest in Memphis. I'm not saying it is. I'm just saying you want to look at different cities and see where is the opportunity today, if it's not in your backyard. A real good example of that is for the folks in California. It's like rarely a good time to do business out there in most market cycles. Because everything is so overpriced, or at least highly priced. We would call it overpriced in Texas. They would just say it's highly priced. So we'll see a lot of California investors buying in Alabama, Tennessee, Georgia, Texas, and other states where it makes sense for them to do so, and it doesn't make sense in their own backyard. So that's market. Now, you can also split the market down into what's called submarkets. So, for example, in the Houston Metroplex, there's as many as 20, 30, 40 different submarkets. That is, smaller pockets within the Houston Metroplex. And they all operate differently of each other as well. So while the Galleria area of Houston may be so hot you can't buy anything, there might be phenomenal opportunities in the Cypress area, or the Katy area, or other areas in that metroplex. So if you're having a challenge finding deals in your own backyard, first of all, look in other backyards within your same geographic market. Those are called the submarkets. And then finally, the other way I dissect a market, the third way, is called by asset class. So let's say that you're just adamant that you're not going to go outside of your backyard. My investments are going to be right here. I want to touch them, feel them, see them, drive by them. Okay, maybe you can't invest outside of your market or submarket, but maybe you could change asset classes. Maybe, just maybe, houses are hot as can be, but there's phenomenal opportunities in strip centers. Or strip centers are not the way to go, but maybe multifamily is. And we could separate and at least come up with 10 to 15 categories of asset class. So when somebody says there's no deals available, that's probably not an accurate statement. They're probably not delving in deep enough and looking into different markets, different submarkets of those markets, or different asset classes. Because if you do, you'll find there's always deals. There's always opportunity. And we always want to be able to do what the market allows us to do. If the market is hot, I'm not a buyer, I'm a seller. If the market is cold, I'm a seller, not a buyer, right? The old adage of we want to buy low and sell high certainly works in real estate as well as it does every other investment class. So you want to buy low, sell high, or buy low and ride it for years and years, which is another great strategy, but you want to do it in the right asset class, in the right submarket of the right market. Hopefully that'll help. And if you'd like more information about Investor Loan Source and how we can help you to finance these assets, go to our website at www.ils.cash or email us at info@ils.cash. See you next time, and I'll see you at the top.